If you're an investor who believes there are no bad stocks, only bad prices, First Data is worth a look. I'm Jack Otter, editor of Barrons.com. I'm here with Jack Howe, senior editor at the magazine. Every Monday, we talk about stocks that are on the move after a recommendation in Barron's. We'll start with First Data, which is up nearly 4% today. Yep. This is not the most exciting business, credit card processing.
There are probably some people out there who are very excited about credit card processing.
We should find them for the next video. Why is the stock up?
Well, this is a company that has a tremendous amount of debt. It has cut some debt, cut its debt payments, but when you have that condition, this is a private equity leftover, right?
And we should point out, and I like to beat up on private equity for this, they take these companies private, they lever them up, borrow lots of money, they pocket that money, and then they give them back to the public in this lousy over-indebted position.
So you've got shares trading at 8 to 9 times earnings. Other companies in similar businesses go for 20 times earnings, 25 times earnings. This is an industry with healthy growth, a long runway of growth. So of course the difference is the debt overhang. Now the key is that adds a tremendous amount of risk for investors, but if you can pay off that debt successfully, and this company seems to be on its way, what happens is in the overall value of the company, you gradually replace debt with equity. It's like a one-for-one relationship. As you pay down that debt, investors are going to say, deserve a little bit of a higher share price here. So the more progress they can make on that front, to me, this stock working is entirely about reducing that debt load going forward.
Let's move on to Red Hat. This was a Jack Howe recommendation. That stock's up more than 2% today.
Yeah, this is open source software, which is free, available to anyone. So how do you make money from it? Well, this is Red Hat, and in the early days of this, they tried, bundling phone support, and it wasn't such a great business. Today, they have a really effective business model where they have basically 2 versions of this operating system that they sell, and one is kind of a more secure, stable, guaranteed version, and the other one is free for anyone and it has rapid updates. And with a combination of those two, they have a big user base, but they make money off the folks who are using this software who really need it to work. If you're running a hospital, if you're running a stock exchange, you don't really care about having an update to your software every other day. What you want is someone who is carefully vetting these updates, testing them, making sure that everyth's going to be stable. That's what you got here. So
you don't always have the latest and greatest, but you can count on stability.
And the innovations work their way in eventually. So you get good software and you can count on it. So it's a subscription-based business. It's worked very well. There's still solid growth there. The key here is now they've got this giant user base, and you can sell them other software. So when you look at the financials, you see the operating system growth is still there, but there's very quick growth from some of the other software, middleware, things like this, other applications that these companies might buy.
And conservative counting, which is always nice. They book their revenue over time, apparently.
There's a delay. They get paid up front, so you'll see that free cash flow. The stock has an elevated price to earnings ratio, and the reason is because earnings revenue, it doesn't get all booked as the cash comes in the door. It gets booked little by little. So the stock if you look at the free cash flow, it's priced kind of in line with the market, much faster growth. So I think shares are a good deal here.
And you think they could go to 95 from what price now, roughly? About 75?
Mid-70s, yeah.
That's nice. Now let's move on to a negative story from Jack Howe. You're a little bit concerned about Ryder Systems.
Ryder has backed up over my toes. I thought that the stock, I like a lot of things that are going on with the business right now. They do leasing services, and it's a business where every company under the sun, for some reason, wants to run their own truck fleet, even though it's a big hassle. There's rising regulation and so forth. So they have pretty simple thesis, which is that over time we can convert a lot more of these companies to doing outsourced trucking business with us, and we'll take the maintenance off their hands and the drivers.
And technology is getting more complicated. Nice for them to handle that.
Yeah, and it's working. The problem is just really in the short term, there's an accounting issue, and it has to do with used truck prices, which for a while they were rising, they were strong, and when that happens, because you buy these trucks up front, you depreciate them over the time that you use them, and then when you sell them, if you sell them for more than the depreciated value on your books, you get the book an extra boost to earnings, and it gives you a nice little tailwind. And when that stops happening, the reverse happens, and that's happening now. It's really subtracting from growth. I think it's going to do that throughout this year. So you're not seeing the growth yet, and investors have punished the stock. I don't really see that condition getting better in the very near term. I do think long term there is going to be a return to solid growth for this company and a higher share price.
Will you tell us before that happens?
I will try to.
Thanks, Jack.
Thank you.